Good evening, ladies and gentlemen. I'd like to welcome you to our final stock market review for 2021. I'm your host, Dan Theok, Senior Vice President of Investment Banking, and I'll be joined today by our very own CEO, Mr. Gary Parrott. Encourage our viewers to post their questions on social media, and remember to tag us with the hashtag #MILInvestorForum. If you enjoyed this program, be sure to like, share, and subscribe to our YouTube channel. We'll also be reviewing our 4 top stock picks for the year, Gary and myself, so be sure to stick around. Now we'll get into our final stock review for 2021. As promised, here are our top picks and its performance. To our viewers, we do hope you found this segment insightful, and we encourage you to stick around. Gary, welcome.
Hi, Dan. Hi, everybody out there.
Thanks for being
Merry Christmas.
Thanks for being with us, and apologies for the absence of our chairman, Mr. Christopher Berry. As promised, please see our presentation on stock market performance. And I'd like to kick off by looking at how the main market index has performed. Year to date, that's for 2021 through to December 14, the index is actually down 1.56%. And if you look at the line on the top of the chart, you'll see where the index was prior to COVID. And you can see that we were down by as much as 33% in April 2020. And the market has been making somewhat of a rebound, but we still have not recovered to the pre-pandemic levels as it relates to the main market. So I think there's more improvement to come. Looking similarly on the next slide at the junior market performance, again, the top line shows where we were prior to COVID, and you can see that the market fell down in April by as much as 39%. But we've in fact had 27.8% recovery year to date, and the index has pretty much recovered to the pre-pandemic levels. So junior market's doing a little bit better than the main market, and as we go on, we'll explain why and who are some of the top performing stocks. On the next slide, just want to show a bit about the trading activity. And again, you can see the movement in the index, represented by the blue line of the 2 bar charts. The blue one on the left shows the volume, and the gray one on the right shows the value. And it's certainly worth noting that the transactions this year are down relative to last year by 3%, while volumes are down by 45%. So definitely seeing less trading activity this year relative to next year. But again, we expect to see things improving as we work our way through the pandemic. And this is for the main market. On the next slide, similarly, we'd like to show what's been happening with trading activity in the junior market. And again, you can see sort of the movement in the index as represented by the line, the blue bars representing the volume, and the gray bars representing the value. And year-to-date transactions in the junior market have actually trended up by 33%, while volumes have risen by 22% relative to the previous year. And again, we'll be looking at the main winners and losers in the junior market as we go on, which will help to explain some of this activity. Speaking of winners and losers in the main market, year-to-date to December 14th, here are the top 5 stocks. CPJ, Siboney, RGR, GK, and Mayberry, top 5 gaining. And then the top 5 declining are Margaritaville, MPC, Wigton, Key Insurance, and Portland. And at this point in time, I'd like to invite Gary. Gary, anything stands out to you in any of these top 5, either advancing or declining stocks? I'd love to pick your brain on any of these, if you may.
Well, the first thing that stands out in the top 5 winners, Mayberry and Mayberry Jamaican Equities hold about 300 positions. Obviously, Mayberry itself has done well. It's the number 5 best performing stock. And I think that's a consequence of the market coming back. So the slide you showed where you had the significant 33% fall off in both the junior market and the main market, a lot of people wouldn't have realized that we're actually back to, certainly for the junior market stocks, for the pre-COVID levels, and the main market is just off the pre-COVID levels. And I think that's the main driver of what we're seeing in the Mayberry stock, because the MJE represents a large portion of the value and earnings of the company. And we expect that to continue into 2022 as we see the broad-based recovery across the economy, but certainly the shares which are held in MJE. And the number one performing stock for the year is a major portfolio stock in MJE, that's Caribbean Producers Jamaica. And they were severely impacted by COVID. I mean, the entire tourism industry was laid flat. And obviously CPJ, as the main purveyor to the tourist industry, would have been impacted, and it was impacted significantly. But, you know, it showed the benefit of having a diversified business. CPJ was well capitalized. And this is another stock that, even though it's a big loser for 2021, could be one of the big winners for 2022.
Thanks for that, Gary. Very insightful. And I couldn't agree with you more generally. And when we come back with our top picks in our next Mayberry Investor Forum, I won't be surprised if you see 2 or 3 of those top losers being the ones that we're picking for. And certainly in relation to the tourism performance generally, we made the point early in the year, as you said, and what this top 5 doesn't show you is where CPJ's low is. I mean, CPJ was coming from a low of $2.50 early this year, and to finish at $10 with good room to grow, if you ask me. If you had timed your acquisition of CPJ appropriately, you could be up 300%. Great, moving on to the winners and losers in the junior market segment. The top 5 advancing are lumber, phosphorus, JMTs, ISP Finance, and Honeybun. And the top 5 decliners are CAC 2000, Access Financials, Paramount, Cargo Handlers, and Consolidated Bakers. Again, Gary, over to you. Any surprises there, and which 2 in particular would you like to highlight for us?
I'm not surprised at the outturn. Again, full disclosure, as we indicated before, CPJ is a major portfolio stock in MJE. Obviously, Mayberry is MJE as well. So in this list again is another portfolio company, Lumber Depot. And what we've seen during COVID is that real estate has done very well. Real estate and construction has been significant construction activity. And Lumber Depot is fundamentally a hardware store that also wholesales to a lot of different hardware stores in the country. So at a time of significant construction, you would realize and would expect that Lumber Depot would do well. And so I'm not overly surprised that it's a top performing stock year to date. It should have some legs if you think the construction industry will continue at the same pace. It should have some legs going into 2022. But certainly the stock has done well. And as I said, it's another stock that's, it's a portfolio stock of MJE. And, so I think we've done a good job in picking and identifying that stock.
Great, thanks for that. And I think we will actually feature both GK and lumber. So we'll do a deeper dive into lumber. Back on that slide, guys, if you don't mind, I just want to spend 2 more minutes. For me, Gary, it was interesting to see the contrast of the top advancing and the top declining. In that top advancing, you had one bakery company, and in the top declining, you had another bakery company. So we see. So I found that pretty interesting. And the same is true for the microfinance business. You see ISP showing as a top performer versus Access Financials. Honestly speaking, for me, the ISP valuation really doesn't make much sense to me at over 50 times PE valuation, and I'm sure it trades with small volumes, but it was certainly interesting to see that the contrast of those 2 industries. Okay, moving on, folks. We also want to talk a little bit about the factors that impacted the equity market, Gary. So it's one thing to sort of talk about top performers, but I think there's sort of a general theme of challenges which we faced this year, which we show up here on the slide. And again, Gary, I just wanted you to speak to 1 or 2 of the challenges, if you don't mind, as you see fit.
Sure. For 2021, so the big challenge was...
So back on the previous slide, guys. Yeah, right, Gary. Mm-hmm.
Yeah, the main challenge was COVID. So what you found is that companies that were geared to benefit from COVID, similar like the food companies, etc., they did very well. But on the flip side, companies in the tourism industry, etc., had a warm time of it. And one of the things that has allowed companies to come through this is relatively low interest rates. If you had debt, you're not earning revenues. But if a debt is growing at 6 and 7%, it's different from back in the 90s when that debt was growing at 80 and 90%. So I think that's a positive that kind of helped to cushion, what was happening. Unfortunately, as I said, on the GDP side, certainly before we started to see the rebound, you saw a significant fall off in GDP. And whilst you see an increase in the GDP for 2021, starting in, I think, the June quarter, the rebound is not yet as strong as the fall off in 2020. But, we remain positive that going forward, this will harness itself and strengthen the growth. We've seen construction hold up the economy, but now we're going to transition because we're actually seeing more tourists coming back. We're seeing the tourism industry opening back up again. The manufacturing industry is doing well. We're seeing where the food is coming back a bit because, as the economy opens back up, people start to venture out. And, and the last bastion is entertainment, so once that starts jumping again, we should start to see a better 2022. The headwinds is inflation. And the big question around inflation is inflation we see in transitory or is it permanent? So we're a large import dependent country, and you've seen where the prices of freight containers have moved from 5,000 US up to 20,000 US dollars. So the question is, do you expect it to persist at $20,000 for 2-3 years? And if you don't, you would expect that to temper into 2022. I mean, if it comes off to a $10,000, $12,000, $13,000 per container, you should see that manifest itself in a reduction in the inflation numbers, And so that is the key point. I think the Bank of Jamaica has taken the position that they have to increase interest rates. And, I support it from the perspective of if they believe this inflation is not transitory, then it is better to be cautious and raise interest rates to keep inflation in check. Because what none of us want is runaway inflation. So it is better to make the error to the downside in that you raise the interest rates prematurely to get inflation in check, as opposed to letting inflation run away. And then what you have to do to stop it at that point would be a significantly negative for the economy, So, the institution that has the most information, the most data is the Bank of Jamaica. And in their view, this is what needs to happen. An encouraging sign, I mean, whilst tourism was down, is the data I'm getting suggests that we're probably around 65 to 70% occupancy. But the vibrancy, when you go to Montego Bay, the north coast side of the island, you see visitors coming back. So, you expect that to continue. We've heard that there are new cruise ships that are coming in. Yesterday I heard that a major cruise line is going to domicile its ship in Montego Bay for almost 16 weeks. So that's going to be a double positive. The tourists are going to fly here, they're going to board the ship, and then also the local suppliers should be in a position to supply that ship. And those are the positive stories you're hearing about. New airports that are sending new flights to Jamaica. And, I wouldn't be surprised if 2022 is a significantly bumper year. For 2021, again, somebody asked me the question, what came to mind was sweet and sour. You started the year expecting it to be better. Unfortunately, with the lockdowns, etc., it kind of soured. But on the back end of 2021, you've actually seen it getting more sweet again, because I think we're seeing the back end of lockdown. We're certainly not expecting to get any more lockdowns. And you're seeing where the government is managing the reduction of the curfews. We've moved from 8 to 10. We've seen where in certain days in December, it will go up to 1 o'clock. And I wouldn't be surprised if that continues into January. And as that continues, it allows everybody to recover, because COVID has impacted not just companies, but a lot of individuals, and, the good thing for us is that there are many individuals who really are on the last of savings, and to hear that it looks like it's going to be over now, it could not have come at a better time, so we're happy to see 2021 go, simply because we hope 2022 will be significantly better.
Thanks for that, Gary. I couldn't agree with you more. And for sure, we are going to have to learn to live with the pandemic and try to transition out of the lockdowns into opening up back the economy more. I was in the Bahamas 2 weeks ago, and I mean, they've completely removed all of the curfews and restrictions because, they depend 90% on tourism. And in the week that I was there, I saw 20 cruise ships come that week. So
wow.
It's definitely something we have to move towards.
Definitely.
Thanks for that, Gary. Okay, so as we move on and jump into our top 4 stock recommendations or picks over the year and do a bit of a deeper dive, first one up is going to be Fontana. Well, it goes without saying that each one of these were stocks we recommended during the year, and I continue to feel very strong about them, so my recommendation is still a buy on them. And I'm going to explain it to you as we go through each of them. So first up, Fontana. Operating profits of $98 million, revenue of $1.31 billion, and this is for the first quarter ended September. Revenue up by 17%. The net profit up to $61 million. That's a 35% increase. So we see that 17% sales translating into 35% growth in profit, 35% growth in the EPS. The total asset base grows by 18%, and shareholders' equity growing by 30%. Not too sure if you could ask for much more. Next slide. Looking at the quarterly performance, when I say I'm not too sure if you could ask for much more, what's interesting in all of this is that Q1 for Fontana is not traditionally a strong quarter. So as they move towards Q2, which is the December ended period, I'm expecting bigger and better things for Fontana in Q2. And add to that, could you imagine if they open up a new location like in Portmore? This stock is just poised for more growth. And on the final slide, we take a look at the movement in the stock price over the last 2 years in particular. Today it's up at 715, which is a PE ratio of about 17 times. I like to think of 20 times as a good average in the junior market, and then you add to that whether you think that stock's going to be growing, and I think Fontana is definitely poised for growth. So great pick at the beginning of the year. It's done reasonably well year to date, and I think it will continue to do well into the future. Over to Gary for any comments.
Yeah, I think this company has done very well, especially the people who invested in the IPO. It got the hit in March, like everybody else, March 2020. But it has shown that the management team is a very strong management team, and they've been able to eke out gains even in the middle of COVID. And, when you look on the Jamaican environment, there is a demand for pharmacies of this quality. So as you said, if they open another location, you'll see what the impact is, because we were able to calculate the impact of opening a location in Waterloo, and so that gives you an idea as to what to expect if they continue opening the additional locations. And the opportunity is indeed there. And so if they're able to successfully make those acquisitions or opening up of those stores, it's a start that, should reward their shareholders pretty well in 2022.
I couldn't agree with you more. Next top pick for us this year, as we do a recap on 4 of the 10, is GK. And again, it's just a great company that's doing exceptionally well. Here we're just looking at the 9 months ended September 2021. They've done $95 billion in revenues for the 9-month period, which represents 11% sales growth. This is a company that only topped $100 billion in sales 3 years ago. And at this rate, they're going to be doing more than $100 billion in 3 quarters. So this will be the 3rd year running where they obviously will top $100 billion in sales. That 11% growth in sales has translated into a net profit of $6.23 billion, or a 26% growth in profitability. Profit attributable to shareholders up to $5.68 billion. The EPS is up to 5.71, which is a 28% increase. Total assets now up to $190 billion, 13% increase, and shareholders' equity up to $65 billion. Again, 15% growth in shareholders' equity. Next slide. This shows you sort of the quarterly performance, and it's a great table to show, because you can see how they continue to grow their profitability over the years. And quarter over quarter, this 3rd quarter 2021 is up some 12% over the previous quarter last year. So again, they're showing really good growth in profitability, both on a quarterly basis and year over year. And on the final slide, want to show you what's going on with the stock price. Again, it took an initial dive at the beginning of the pandemic, had been flat for many months, and GK tends to trade like this, tends to trade flat for 6, 7, 8 months at a time, and then it sort of tends to make a big move and then trades flat again and then moves again. Today up to $99, so this is up quite a bit from the start of the year, around about $60. And what's impressive about that is because of the growth in earnings, it still is only trading at a PE ratio of about 13 times. In a main market where I like to think of 15 times as being at par, and then you again make your premiums or adjustment based on the growth potential. And here is a business that's showing great growth potential. So at a 13 times PE, I obviously think it has great legs because we're seeing good growth from it. We're seeing the fact that more than 50% of their profitability will be coming from outside of Jamaica by next year. So they've done a great job of diversifying the geographic sources of profitability. And in terms of the segment analysis, we see both the food business and the remittance businesses growing and doing pretty well. So it's a great stock, I think. Gary, any thoughts from you?
Well, again, this is another stock that I think, the team at Mayberry, sensitized a lot of people to. I mean, I think when you saw that stock taking off, it's around the time that, we showed the analysis that, this conglomerate, if you stop and think about it, that this conglomerate was perfectly positioned for COVID. They're into food, both locally and internationally, that did very well in COVID. They're also have a huge remittance business, which has done extremely well during this time. And I think their challenge was, people were questioning the sustainability of it, but Don has a team there that's executing very well. And, what we saw, especially in the September quarter, when we said, hey, this is the time to move, is that we realized that this is going to be sustainable. Their products like their patties in I think it's Walmart, and that ensures that sustainability will continue. And as you pointed out, they've always had, intentions of, earning more than 50% of their profit outside of Jamaica. It's just that Jamaica kept growing so fast, but I think they're finally going to get there, and this is a stock I think is another stock that's going to do very well. It's very difficult to get shares in big volumes. And so when institutional investors are trying to get in, the price is going to jump. And I think once we get out of the pandemic and people realize that these sales and profits are sustainable, I think this stock, has significantly more legs in it.
I agree totally. Right, next one for us will be JMMB. And when we finish this, folks, I do want to go back to, I believe I missed showing how the top 10 picks of Mayberry performed this year relative to the market. That's very important, but I am doing a deep dive into 4 of those 10. And when we finish the 4, I'd like to go back and show you that index because I can't help but remind you that had you picked the top 10 we provided, that your performance would have been exceptional, I think at least 45%. So JMMB, another one of our top 10s. Of course, we're looking at the top 4s here. Thank you. Looking at the net operating revenues of $13 billion, which is a 25% increase over the same period last year. So this is 6 months to September 2021. They've grown their net profit to $5.49 billion and grown their net profit attributable to shareholders to $5.1 billion, an increase of 120% over the prior year. So they're definitely kicking butt. Total assets up to $562 billion and shareholders' equity up to $64 billion, a 30% improvement in shareholders' equity. On the next slide, it just shows you a bit about what's going on with the quarterly performance, and you can see strong performance in Q4 and in Q2. That 100% growth in profitability is really driven primarily by the $2 billion turnaround in the performance of its investment in its associate Sagicor Financial Corp, where last year it contributed little or nothing, and this year it's contributing $2 billion. So I think that APO, where they raised $12 billion and used it to sort of augment the acquisition of their 23% in Sagicor Fin, is obviously paying great dividends, with them seeing $2 billion, or about 33% of their profitability coming from their investment in that business. And I think JMMB has done a pretty good job in diversifying themselves geographically. If nothing else, we see the Dom Rep business also doing exceptionally well, improving in its contribution to total revenues by over 365%. And on the last slide, again, looking at the share price performance, again, the stock has been trading pretty flat, having declined since COVID levels. was trading pretty flat at $33 for quite a bit. I remember recommending it to quite a few friends aggressively at that price, reminding them that they had an APO at $38 and had over $14 billion come in. Now it's finally back up to $38, which was that APO level some 2 years ago. And this represents a PE of 7.22 times. I'm just amazed. Again, in a market where 15 times for main market is about average or par. So by contrast, NCB is trading at a 20 times PE, and here it is, JMMB is trading at 7 times. So this blows my mind. It shows you that there's great value to still buying JMMB at $38 at this time. And we're not even going into what our top pick recommendations will be next year. You'll have to tune in to get that in our next program. But for sure, JMMB, I would imagine, will be one of our top 10 recommendations. Gary, your thoughts on JMMB?
Well, I mean, I know it's been your favorite stock pick for the last couple of months, but 7 times PE tells it all. Keith and his team, I think they made a big move when they invested in Sagicor Financial. And certainly when you see what is happening with Sagicor locally, whereas in my opinion, Sagicor looks like they're breaking out into another phase, and that's going to feed into the associated results of JMMB. Their core business continues to do well. The bank, everywhere you drive around, you see financed by JMMB. So again, this is another business that it's doing well, but unlike a lot of the other shares or stocks that we spoke about, this is probably one of the lowest PEs. And if you remember, Dan, when we interviewed Keith, I think a couple of months ago, he made the point that JMMB had the lowest price to book of any financial institution. Actually, only Mayberry was lower than JMMB at the time. So, and we're seeing it here. Mayberry ended up being in the top 5, and it still has more legs. And, the JMMB is poised, at 7 times. So even if it gets to 10 times, that's about $40, $50 a share, So for investors out there, at this stage, I'll say to those who are buying, just keep buying, The longer it takes the market to realize that this stock is undervalued, it's the more money you will make when that realization reaches.
Absolutely. And just to go from 7 times to 10 times would be a 40% increase in valuation.
Yeah.
And I remember keenly when we had Keith on that program and we asked him for his one of his top picks, and he said Mayberry.
Yes, he did. He did.
He absolutely did. So there you go, folks. Okay, moving on to the last one, last of our top 4. We want to take a look at Lumber Depot. And this is a great company. Lumber Depot, hasn't been on the market that long. Remember, this stock had an IPO at $1.20. And, if my memory serves me well, in their first year, their profits were only $22 million. Here they are in their first quarter of 2021, turning a profit of $72 million. So this is insane. Revenues up to $420 million, 16% improvement over same time last year. Gross profit up to $103 million, a 55% improvement. So they're improving their margins, and we've seen this for the second quarter running. Now, the first time I saw this happen in their fourth quarter of last year, we wondered to ourselves, is this them just taking advantage of increases in shipping and they're selling out of their inventories? Could that be why the margins have gotten so rich? And here they are 6 months later, and their gross profit margins have still held, and sales have held. It's fantastic. Net profit up to $71 million. That's a 140% increase over the prior year, and earnings per share similarly reflecting that 140% growth. Meantime, total assets are up to $569 million, which is a 29% improvement, and shareholders' equity up to $395 million, an improvement by 78%. So, man, I'm looking forward to some dividends out of this one. On the next slide, you can see the quarterly performance, and they've had one bad quarter in the last 2 years, right? Q4 2020, and since then, you sort of seen the falling 3 quarters in that kind of levelized $32 million space, and then in the last 2 quarters, as I said, they've just been knocking it out of the park, $64 million and $72 million respectively. So when you look on the final slide, this is what's helping to translate into an EPS of only 12 times in a junior market, where I like to think of 20 times as par. So this thing's undervalued by at least 40% relative to the junior market average PE. Of course, you have to ask yourself, are these levels of earnings sustainable? But regardless, this is a stock that has increased in value by more than 40% this year, and perhaps still has good legs. I don't know. Gary, what are your thoughts?
Well, as you pointed out, Lumber Depot has done very well. I think Lumber Depot is probably the #1 hardware store in the entire country. They have very good relationships with their suppliers, a very good relationship with their customers. And as you say, they're knocking the ball out of the park. They, as I indicated in my earlier conversation, construction has done very well in Jamaica in the last 18 months. And Lumber Depot has benefited significantly from that. But as managers, Dan, how these things go. You make a profit you make a record profit this year. Shareholders want a bigger record profit next year. So let's see how this one pans out for 2022.
Great, I look forward to it. And so when you put that all together, folks, I want to show you the Mayberry index for 2021. And what this does is it looks at the top 10 stock recommendations we made throughout this year, which included, as you can see there, GK, which we've done an analysis on, and Lumber, which we just did an analysis on, and JMMB. But it also included Carib Cement, Mailpac, Lasti, MDS, and Phosphorus. And we saw 3 of these turning up in the top 5 performers, respectively, for their segments. Had you bought these stocks at the beginning of the year, all stocks which we've done deep dives and recommendations on, your portfolio would be up a whopping 49% year to date. So that's, the proof is in the pudding. Our recommendations combined are up 49%, and that's when we weight them. And that compares to the main market average index performance, which is down 1.5%, and the junior market, which is up 27.8%. So there you go. Mayberry's top picks are way outperforming the market, and that's why you guys should keep tuning in to the show. Gary, any comments?
Well, I think 49% says it all. I have to give thanks to Jason Martinez and his research team. They have created significant value, or they've produced data that should create significant value for people who follow it. So I know he and his team work some very, very long hours to decipher the voluminous financial statements to produce these picks. And, I say to the investors out there, join us in early 2022 when we put up our picks for 2022.
Absolutely, absolutely. And I think 2022 is going to be a better year than 2021, if you ask me, when we think about the macroeconomic conditions and all of the factors that we spoke to earlier, and how we should be getting some breakthrough results on some of those fronts going into 2022. Great. So up next, we'd like to do some Q&A. Great. So first question coming in is, what's your view on how the finance sector will perform in 2022, especially in light of the interest rates going up suddenly? So Gary, I'll turn that one over to you. So someone's asking specifically about the financial sector.
Well, this is a double-edged sword, for want of a better word. Banks are fundamentally a repository of cash. So increased interest rates will lead to increased interest income. When in an economy where interest rates have been relatively low, when the central bank sends a signal and starts to raise interest rates, they're saying, slow borrowing, let's increase some savings. So the financial institutions should do well, especially those that are significantly more liquid than others. And, what we look out for is we're not seeing sharp increases. We're seeing gradual increases. So Governor Biles and his team at BOJ are taking their time. They are sending the signals, that, hey, listen, we're not happy with where inflation is, and we're going to do everything in our power to keep inflation under control. But notwithstanding that, you've seen the 0.5% movement, 1% movement. You're not seeing in this significant past 5 and 10% movements at one time. So it allows the customer and the consumer to change their spending patterns. It allows the financial institutions to rearrange their books in terms of how much more cash they will keep vis-a-vis new loans. And, I think the financial sector, from that perspective, should do better. The big X factor is what's happening on the delinquent portfolios. We've seen 2 years of, very hard times in terms of restructuring loans, etc. And especially on the personal portfolios, credit cards, salary loans, we need some more insight as to what the situation is with that. But, fundamentally, when you look on the regulatory ratios, all of the financial institutions, are beating those minimums. So going forward, if it's a continued gradual increase in interest rates, I expect them to start to do better, or do much better.
Thanks for that. I appreciate that, and I agree wholeheartedly. And second question, which I'm seeing here, is which industries have shown their resilience since the onset of COVID-19?
There have been several. You can look to certain companies in the tourism sector. They were hammered. They were closed right down. So you look at a CPJ, the fact that a CPJ was able to weather it. They're the largest purveyor of goods and services to the hotel. They've shown a certain level of resilience. But more importantly, if they continue that profit trend that they're showing now, it's very likely that they'll probably make back all the money they would have lost during COVID. The food industry has benefited. But a big shout out to the financial institutions, my peers, etc., in that it has been managed. I mean, also the central bank has been integral in managing that process. If people remember, they came out of the box early, suspended dividends. They wanted banks to preserve capital, build liquidity. So we've come through that period where you've not had what I'd refer to as bad debts that would have sunk any institution. You're not hearing anything like that. So the banking industry, has stood up pretty well. And, over the next year, I think as they continue to manage that, maybe the back end of 22 to 23, you actually see them sprint out of the box and continue doing better. And, Dan alluded to a situation, earlier on in the show, in that when you looked on the top 5 and the bottom 5 for the junior market, you saw similar companies, and maybe the story for that is the management team, so some management teams were able to handle the crisis better, and you saw that in their results, and others were not as good, and they ended up in the bottom 5, So, so that industry would have been resilient, but within that industry, there are some people that were able to do better than others, The real estate, I personally am surprised that the real estate and the construction sector, it has done very well. I think the country has benefited significantly from it because it was able to maintain certain jobs in the economy that we would not have had. And, the level of construction throughout COVID and the fact that it is continuing, has just been a godsend for the country. We look at that to see whether they can continue that pace. But as I said, that was more than resilient. That was even a growth industry than during COVID. So those are the ones that stood out for me. I mean, probably a Wigton in terms of the energy side. You saw that they were able to maintain, and there wasn't a dip fundamentally in their volume of revenues. I mean, the pricing was a different story. But they were largely unaffected. So again, it was one of the, I think the word is called non-correlated stock,
Right.
So,
and that leads me to the third question, Gary, which I believe, if you guys could put that up on the screen, the third question that we got in. What is the outlook for Wigton wind farms given the global push to renewables in the near to medium term future? And that one came in from Kyle Howard.
Yeah, well, Kyle, we had touched on it before. I think that Wigton has the potential to be one of the best performing stocks in 2022. Not just the international outlook, but the local Jamaican government. If people remember the IPO, the minister indicated that alternative energy is going to represent a much greater percentage of the energy mix going forward. And with the amount of cash that Wigton has on its balance sheet, it is perfectly poised to win most of the energy bids when they come to market. Not a matter of if the government is going to achieve their objective, they're going to have to start to come to market for bids for X amount of megawatts of energy. I think Wigton is poised for that, but notwithstanding that, if you do a proper analysis and valuation of Wigton, you will see that it's worth more than the 50 cents that it's trading at now. But my philosophy. The longer it takes people to realize the value in the market, it's the more time that you can buy more of the stock.
I couldn't agree with you more.
When they realize you make some more money, don't argue, just buy.
I feel that way about JMMB and Wigton. Of course, let me declare interest. I am a board director of Wigton, but again, it makes no sense that it has a $5.5 billion market capitalization with $4 billion in cash. And by the way, yesterday, I think they made public the dividend that was declared. So there's a $200 million dividend that was just declared from Wigton. So folks, look out for more stuff like that in the future. I think we have 2 more questions. In fact, I think we only have time for 1 more question, guys. So the final question, if you will, guys, could you put that up for me? Now that Honeybun has completed their 10-year tax break, what's their recommended next best move to maximize shareholder value? Is Honeybun still a good buy at $9.50? That comes in from Philip Burgess.
I think that question is best directed to the management of Honeybun, Michelle Chang, who does a great job there as the managing director. So we wait to see what signals they send. But it was interesting because Honeybun was in the top 5, and one of their competitors was also in the bottom 5. So management is going to be key.
Good point. I couldn't agree with you more. Great. So that's it for our Q&A, folks. Running a little tight on time. Now we want to move into our market segment, where we want to look at the movement in the foreign exchange. And if you guys could put up that slide. Gary, can you see the slide? Do you want to talk to it, Gary?
Sure, but I'm not seeing the slide. I'd love to see it.
Great. So the first slide, folks, Gary, are you seeing it?
Yeah, I've seen the slide now.
Good deal.
But the slide I want to see, which I think will explain what happened in 2021, is the trading slide, the one that shows the peaks and valleys.
Very good.
I think there is another one.
The next slide, guys. There you go. There you go.
Yeah. So this slide is a trader's dream. And this is what we spent most of 2021 trying to explain to, financiers, financial accountants of different companies, etc. So what you saw here is all these hills and valleys is where a lot of people made a lot of money and where some people lost a lot of money. Because what happens is that every time the dollar runs, people knee-jerk goes out and buys them. So when it hits that high at say 140, people went and bought, and then the demand disappears and it collapses to 135. So if you're able to stay disciplined and bought in and watched your channels, you weren't buying at the high and selling at the low. And so overall, you had about a 9.5% devaluation for the year, Dan?
Yes, that's correct.
Right. But within that 9.5 overall devaluation, you had these peaks and troughs in some instances with a differential of $7. And if you followed this was the difference between almost 10 to 20% of company profits during the year. Because if you're able to buy at the bottom in the valleys and restock when you get to the next valley, you are making 10 to 20% more than your competitor. So if I'm buying goods at 140 and my competitor is buying at 135, they have that margin band that they could build into a lower price and take all the customers. So, we try to tell a lot of people in 2021 to look on the bands, look on the channels, and those will determine your buy and sell signals. And if there's anything you can do for 22, this is what you need to look on, because this is the volatility that the current policy of the arbiters of the market now have in place. So they talk about two-way movement. You have wonderful two-way movement, but for an expert foreign exchange trader, it just means more money for them. For a company that doesn't understand this is just additional cost. So going into 2022, it's going to be key to watch the inflation numbers, because it's interest rate parity theory. The differential in the inflation between yourself and your major trading partner tends to give you an idea as to the level of devaluation that's required. So I think our inflation is running at about 8%, Dan.
That's correct.
Inflation in the US is around 3 to 4%, give or take. So you're looking at a 4 to 5% devaluation at the very least going forward. So when you're putting together your guidelines in terms of your buy signals and your sell signals, you need to take that into account. So I think the dollar will continue to devalue into 2022, but I don't think it will devalue as much as 2021. We've had a 9% devaluation. I think in 2022, the devaluation is likely to be less. But again, when we do our show in 2022, we'll have more data to be able to give you a better prediction as to what is going on. But I conclude, Dan, by saying that given the policy that the government and the BOJ has right now, I expect for 2022 to see a similar graph of peaks and valleys with the movement in the foreign exchange rate. So if you're able to buy, if you do your analysis properly, you will know when to buy, when to sell, and you should get some nice incremental profits from managing that foreign exchange.
Thanks for that, Gary. Really appreciate that. And that wraps up our U.S. foreign exchange segment of the market segment. Usually we would have on display for you our top gainers and decliners for the week. Unfortunately, we don't have that, but I can speak to it, and if time will permit, I will just sort of let you know what the top decliners and the gainers were. So this week, the top decliners were SSVLC, down by 12.1%, Lumber, down by 11.6%, MIL, down by 9%, Epley CV, down by 4.7%, and Northford Express, down by 4.14%. The top gainers for this week are 138 Student Living, up by 17.6%, Portland JSX, up by 15%, Everything Fresh, up by 9.2%, Berger, up by 8.7%, and Access Financials, up by 7.69%. Well, that was a really great show. Haven't done this for a couple of months. I'd like to thank everybody for joining us today. I'd especially like to thank our CEO, Gary, for being with us and for all of his insightful contributions in this final stock market review of the year. We hope you'll join us in January for the return of our virtual investor forum. Be sure to follow us on social media to stay up to date with our live streams. And don't forget to subscribe to our YouTube channel, Mayberry Investments Limited. And if you haven't already, be sure to download the Mayberry app, MIL Portfolio, which is available on iOS and Android devices. Keep safe, and remember, wise investors, slow and steady wins the race. Merry Christmas, all.